Well, here we are. Welcome back to the PDPW Dairy Signal. It's a new year for me. This is the first Dairy Signal I've had the opportunity to lead, and we're jumping right into markets. I don't think there's going to be big surprises out there. All of us that are farming, we know that pretty much right now, things that come from the ground just don't have the value in the marketplace that they've had years prior. And we're looking for opportunities. And that's why today is a great opportunity to work with one of our resources, great resources that we have here, homegrown in Wisconsin, another farm boy that definitely understands the volatility that we have in the marketplace in agriculture, and that is Leonard Pozine. Leonard comes to us from University of Wisconsin Extension team, a fantastic and strong team that we're blessed here in the heart of the dairyland, and he is a dairy markets policy outreach specialist. Leonard, tell us a little bit about yourself.
Yeah, so thanks for having me. I always appreciate this. It's always a pleasure to be here, contribute, and share the information that we have. Dairy Farm, we're kind of our one of our unique things in our farm is red and white Holsteins. So showed cattle all over the place, brought animals to expo, kind of the whole nine, right? So we're still milking cows and still farming. So yeah, we're it helps to kind of bridge that gap, right? So it's easy to talk in theory and practice, and we'll have a little bit of that here today. But I get that guest checks that came out were quite a bit lower than folks were expecting here recently, and as we get towards the end of the month, it'll be very interesting to see what the second milk check looks like. I get it, that's for
Yeah,
sure.
you definitely get it. If you grew up on a farm, you still got a foot on a dairy and enjoy good cattle. I mean, there's nothing that's going to surprise you, but it's never a good surprise when the guest check is much lower than what you guessed. And it looks like 2026 could hold a lot of volatility, and we're hoping that we get some bounce in the marketplace. But you're here to kind of shed some light on what's ahead, and I'm all ears for where is the opportunity. They always say the old adage in business is buy low, sell high. In corn and in beans and in milk, there's not really been enough volatility to make this ball bounce again. So I'm going to have you shed some light on this, and more than anything, give us an outlook for what to expect so we can focus on the things that we can truly manage and maybe just hang on and find some strategy in other parts of the businesses for the things we can't change.
Yep, for sure. The agriculture and dairy in general, right, is you buy retail and sell wholesale. So in order to capture margin in there is no small feat. So as time goes on, like I shared with Shelley before we joined here, is that dairy has never been easy. And I don't think that it's going to get any easier, right? So I think 2026 is going to be no exception to that. But I do think there might be some room, for those operators that are, dialed in, looking for opportunity, looking for the next things. And also, there are a few things to watch out for as we go along in the year in order to capture some volatility. Maybe there's some risk management options that come out there, things like this.
Okay. Well, we're going to be listening keenly, looking for those opportunities and those options.
Perfect. So one of the first things I want to jump into here is some of your risk management considerations that you might be thinking about kind of going ahead. But before we do that, I want to kind of give this overall idea or theme that seems to be happening here in the first part of 2026, and that we're getting a very big supply-led adjustment in the dairy space in the United States. So the reason that that's important is I'm just going to set the stage here a bit. Historically, milk production growth led supply growth. So if you look over the last 20, 30 years and you average it out, we saw about 1.5% growth, give or take, per year in milk production across the US. And then we saw about $1.5 billion of investment in processing to match that growth in milk production. And a lot of that end product was utilized domestically, specifically in cheese. We've seen this big, growth in that cheese space and that processed space in general through that time period. Well, right now we're seeing a very large investment in the dairy processing portion of our industry. So some estimates have it up to $11 billion. So, like I said before, we had about one and a half, $2 billion was a lot per year or in a year historically over the last 20 to 30 years. So we're taking a very large amount of investment and kind of condensing that down to a very short time period. So when we had, and this is a lot of these announcements for this processing capacity are anywhere from 2023, 2024, all the way up to possibly 2028.
And I look at that as good news. I mean, we have to have our processing sector reinvesting if we're going to be competitive long term. So, that's not totally bad news for dairy farmers.
It certainly offered the option for growth for those folks that are coordinating with their processors and are in those geographies in order to be able to take on that new milk. So what I get asked a lot is hey, we have the new processing capacity. When we first heard about this, there was some folks that expected that milk price was going to go up because we have that increased demand for milk, right? Well, what we found is that there's been that producer response through cow numbers, through milk production, all of these things. We've been able to meet or exceed that new demand relatively, well, fairly quickly, right? So while at the beginning, some folks thought, hey, maybe there would be this a bit of a competition for producer milk. We were able to ramp up quicker than what some folks expected, and so that's why we, have kind of seen some of that down pressure there. And also, we're starting to see some new product come online. So as new product comes online, the market has to clear that until we kind of find this new normal in price ranges to kind of find where that equilibrium is for those new products coming out. So that's why we'll talk some more about processing capacity here, but we've kind of we'll go back to Econ 101 for just a second and talk about a shift in along that supply curve versus the whole supply curve shifting, and that's kind of where we're at right now, is that supply curve has shifted out. So we're trying to the market is trying to discover, hey, where are our price points along this new supply curve? So some other things that we'll talk about is right now there seems to be some incentives that are either misaligned or mixed, right? Where some things are saying, hey, producer, make this decision, and then some other market signals are saying, hey, make this other decision, and sometimes those are competing right now. So which kind of makes it somewhat difficult on that producer side in order to say, hey, what actually is the market asking for here? So that way you can make decisions from it. So we'll kind of go through what those are and what that list is. And then also when we have these mixed signals, and if you have that supply-led adjustment, historically what you see is a very slow response and extended low price periods. So I encourage you just to think about that, right? That as some of these market signals are being fleshed out, and as we kind of go through this time period, all else equal, we could be having some period of time here that does end up being a transition until we kind of find, like I said, that new sweet spot for us. I don't want to spend too much time on the recent news here, but through the One Big Beautiful Bill, the Dairy Margin Coverage Program was reauthorized. So very soon here, you're going to start to see this come up in the news headlines because the final rule for the Dairy Margin Coverage Program, which producers will be enrolling in the future, the final rule for that program came out yesterday. So I want you to know right now that we'll go through what those main changes are and what they mean for you, but then also keep an eye out for that enrollment date. Think about, you'll see the headline now. Right now, we're not announcing the enrollment time period. We're announcing what the changes are when that enrollment period does come around. So again, the first change that's happened is that the Dairy Margin Coverage Program has been reauthorized through 2031. And the big thing here is that the tier 1 coverage level has increased from 5 million pounds of production to 6 million pounds. So there's still that 25% premium discount for operations. And, really the mechanics of the program are the same. It's still income over feed cost. The calculations are still the same. The premium is still the same. The coverage levels are still the same. But what's changed is that 5 million to 6 million pounds. And also the ability to update your production history. So what you're able to do now when you enroll is to update your historic production history based on the milk that you marketed from 21 to 2023. So those are kind of the big takeaways is you can get updated production history. You can now cover up to 6 million pounds. And you still get the premium discount. So watch FSA, make sure you're aware of, and if you're going to sign up in the program, think about watching for that. So I know there's all kinds of views and ideas on how dairy margin coverage works and how to change it. I love that discussion. It's always fun. So if anybody ever wants to do that, feel free to let me know. But I do think that it is a valuable tool in your risk management toolbox, specifically because it doesn't limit you from using other tools. So even if you don't do all of your production, even if you just look at some portion of it, and I realize that a lot of these feed prices have caused us not to trigger a payment lately. But I would say there's enough wild cards out there at the moment that foregoing, at least considering it, I guess wouldn't be my recommendation.
So given where we are in corn and beans and our overall formula, what would be a kick-in target, you think, with milk price?
I have not looked at the numbers recently, like in terms of like the last few weeks here as we've been, and that leads me to a great question is right now we're updating the software for the analysis tool. So that way you can have a better experience in kind of evaluating your coverage levels would be at. So I have not looked at where that trigger price is, within the last week or so, but, we're getting closer, it seems, that's for sure. So,
Not a hopeful target that we want to hit, but it's an interesting one when it comes to the formulas. Okay.
yep, just like insurance, you don't want to use it, but if you have to
Right.
use it, it's nice that it's there. So,
Right.
something to think about. If you're watching, I do have a graph here that just kind of looks at where the premiums per hundredweight are on those different coverage levels. The big thing takeaway is that obviously that tier one coverage, which is that first now 6 million pounds, substantially less than the amount above that. But if you are looking at covering, amounts that are above that 600 pounds or 6 million pounds in your operation, I would encourage you to at least do the math on what tier two looks like. There'll be times when I've done the math and it is surprisingly competitive compared to other options of risk management, right? That doesn't mean it always is. It depends on what the market is giving you. But at least take a look, do the math, see what pencils out. So, that kind of leads us to this idea of mixed signals right now. So this is kind of where we're thinking through these things so that way we can come up with what maybe a long-term view looks like, right? So if we can kind of, stretch out a bit from today's timeline and look out 3 to maybe 6 years from now, and see where some of these price signals might lead us, hopefully that'll lead us to some management decisions today. So right now we have weak milk prices, but we continue to see process-driven expansion. So why that's a mixed signal. First of all, like I said before, when we historically we saw milk production increase and then processing capacity followed. What we're seeing now is the complete opposite of that. We're seeing where processing capacity increases, then in those locations to meet that new processing demand, that's where we're seeing our cow numbers grow, right? And also historically, when we saw milk production grow, it was usually based on margin, right? So as you're more profitable, you reinvest in your business, become more efficient, grow either through, intensification or extensification, grow within your business or grow by, acquisition, growing, expanding, things like this. So that's very different now because, like I said, before we were margin drove the expansion. Right now, it's location and access to processing that's driving that expansion. So what that means is that as those folks that have the good established relationships with their processor, that have been coordinating with them, having those conversations with them, when the processing happens or when that expansion happens, they're able to find a home for their new milk, right? And the one big thing here is that a lot of time, historically, in the last few years, the market has been giving dairy producers the signal, hey, we're good where we're at. We don't need any new milk, right? And what's happened is that that's now shifted, and processors said, hey, yep, we'll take more milk. So if you're a producer and they came to you and said, hey, would you like to grow? Would you like to expand? It's pretty hard to say no. So, gave the big thumbs up, green light, and away we went. So, kind of a shift from where we historically saw growth and how we saw growth and where this, producer processor interaction is. But I do think going forward, that's going to be a lot of how we are allocating our growth and our expansion. So, and with that, we're also geographically based in expansion versus like kind of, nationally or even across the entire state, raising our cow numbers. So, the
So
other thing that's happening.
looking nationally, Leonard, where are they poised the best to see the most sustainable growth? The Midwest has been doing pretty good in the last few years, but now we've got the Southwest building more. If you were to look at it across the country, where's the greatest advantage right now? And greatest
Where a lot of that investment happening is almost if you make a T across the United States. So where horizontally kind of at that Midwest to East Coast and then out west as well. So think Idaho, and then when you get out east, you're looking at New York. New York is the big Chobani plant that's going in Rome out there. And then in the central part of the state, Kansas, some in Texas. In a second here, we'll kind of look at a map and then walk through, the states
Okay.
that seem to have some increasing things and look through what some of that investment is too. So, and a lot of these plants are getting supplied by milk or with the solids they need faster than what historically we've seen them get components in, because we are increasing our not only milk per cow so much, but also our component production per cow so much. So when that happens, we need fewer cows in order to be able to meet the demand for the new processing capacity. So that's kind of this other almost tugging at two ends of the same rope of, hey, we need more cows, but at the same time, we don't need as many as before. So, it's easy for us to kind of overshoot that supply here, especially in that short run. And the other portion here that's really kind of being a big mixed market signal that we could probably spend the next 3 hours talking on is the beef market and how that's influencing the dairy sector at the moment. The one big takeaway there is, for me, is that right now it's paying a lot of bills. So normally, historically, if beef prices are within their historic normal ranges, from the data set that I have and the finances that I can kind of manipulate and take a look at, we would be in low single-digit percentages of gross revenue on a dairy operation that are derived from that beef market. So by that I mean think cull cows, terminally bred, your terminally bred animals, your bull calves, things like this, right? Right now, we can get into that double-digit percentage of gross revenue from these animals. So if that's the case, that means that we're paying a lot of bills, and that's really kind of what is holding up a lot of these operations that might be, having a tough go from some of the current milk prices. So what does that mean in the long run? That's a good question, right? Because is that going to prolong some of the downward pressure in our prices? Because we're not seeing the supply response changes? That's a good question. I haven't seen enough good, actual, justifiable, verifiable data and information to say one way or the other yet. But I do think there's certainly, really great, interesting conversations. The other mixed signal that we're getting is exports. We have excellent exports right now. And in addition, we have excellent domestic demand. But even so, and we're moving a ton of product, we're not seeing this bump in price that historically we saw, right? Usually, if we have great exports, we see some increase in milk price. So what that tells us is that right now our exports are clearing markets, but at a discount, right? So that's why we're seeing the price pressure. Where historically, sometimes when we see exports, especially in that butter side, usually if our butter exports are really high, we tend to see a price bump. But right now, the market or the international market is clearing our product versus giving us a premium. In that cheese space, where a lot of this new processing investment is going to be in cheese, so we have to move that, outside of our borders, whether that's down south or overseas. So if we continue to increase our production, we still have to clear all that product. Also, on the good side of that is the whey production. So the whey complex is really kind of adding a bump to that class 3 space, but specifically is that high protein whey. So the question I get asked frequently is, well, how long before we oversupply that? And my answer is nobody knows, but the good news is that high protein whey is not a cheap thing to make. So our investment in broad spread capacity in order to do so, I don't anticipate is going to be instantaneous, right? So like I think we have a bit of a longer tail there on that high protein whey space that will continue to help bolster some of that class 3 price. So the big takeaway here is that I think all of these conflicting market signals could extend the price cycle that we're in. And also keep in mind, we haven't seen the full effect of this supply response yet. We're still, anywhere from 20%. I guess the ranges vary a lot depending on announcement, but we're still we're still at, I would venture, according to the math that I have, at the beginning stages of this investment capacity process. So, as we kind of take a look historically, when we've had oversupply events, they can take 3 to 6 years to reestablish where our new normals are. This kind of gets to your question, what some of these investments look like. I have a map up here, and I've just kind of put dots across the United States of where processing capacity has been taking place when it was announced. And I'll be honest, I kind of quit counting at $7 billion of investment, and right now we're announced at about 11. But I always tell people, if you kind of squint at the map, you can kind of see that T that we were talking about that kind of fits across the United States. And where we're really seeing our big changes in milk numbers, or sorry, in cow numbers are just that right in the middle of the United States, Texas, Kansas, a bit in South Dakota, and then that top of the T, Idaho, Idaho, South Dakota, Minnesota, Michigan, New York. So I think as we go ahead in the future, we might pick up a few more towards the east, just kind of depending on where some of those new plants go in, especially in that fluid space. But otherwise, those seem to be the geographies that a lot of these plants are going into. So I think if you're in those regions and can capture that opportunity, that'd be a good thing there. So we talked about this a bit here, and I won't go into too much detail, but we talked about, just like in economic theory, this change from up and down a supply curve, which means that, you have a change in supply, you have a change in price. But if you have a complete shift in your supply curve, which is what I think is happening right now, in order to get the same price, it's going to have to be at quite a bit greater quantity that's going to clear the market. So I think that's the reason why I think we're kind of fundamentally entering a new range of prices, and that's what the market is trying to figure out is, what does this look like? How big is the new supply going to be on the product? How are we clearing it? What is the product mix going to be? All of these things. So, I'll get asked frequently, what is the forecast? What is the outlook? Honestly, there's zero crystal ball. And I always think, one of the best measures to give some sort of information here is the class 3 futures. So just updated today, our class 3 price average for all the way through 2026 is 16.78 for that class 3, and for class 4, we're at $15.49. So, I was asked very frequently, when do we think this class 3, class 4 spread is going to invert? Well, it seems to have happened. And also, if we continue to see more processing come out in that class 3 space, then potentially have more price pressure there. The one thing I do want you to take away from this is two things. First of all, right now, the backside of that class 3 curve, which means those further out time periods, are offering higher prices than they are currently. So that means that there is risk management opportunity. Also, when we go through these long supply adjustment periods, oftentimes there will be some volatility. So volatility can potentially produce some fireworks in the market that may give you a chance to cover some risk. So I understand that covering risk at below optimal or even sometimes below cost of production numbers is not that much fun. But even doing a percent of it at some of those levels might be something you want to think about. So the other thing that I would look at on the CME is our cheese futures, because that's really going to be, especially here in the upper Midwest, a big determinant of where we are at and where we're going to be heading into the next quarter. The one big thing is we kind of take a look at the first quarter of next year. I think that we have some exports booked. I think we're moving product, right? The big question I have is what happens in quarter 2 and 3, because if we are at a discount to the rest of the world, and now all of a sudden, if our prices come back or if the rest of the world gets more competitive, then we could see this, we could get a bump up in price. And then if we're not booking exports, then, that rest of the year could look tough.
So this is, what you're estimating on the price that we'll be taking. Do you have any idea what is running for kind of the average cost of production right now across the Midwest and maybe even across the T? Talk about that, what you're seeing.
Yeah, that's a very good question. The academic answer is that we see an incredible range of cost per hundredweight across operations in any given year. And that when you kind of graph that out, that range just kind of shifts up and down with the market as prices change. So, and that range is always about $10 per hundredweight difference in cost of production across producers. So, very widespread. To try to give some kind of answer, I think there's a lot of folks out there that are, $18 a hundredweight in cost of production. I don't think that's an uncommon number or outside of any realistic range. So I don't have any math or anything to verify that, but just in conversations that I have with folks, and you kind of start thinking through, where costs are at on things. I think that's likely a number that probably a lot of folks will resonate with.
So our dairy world is really going to, if this continues on the trajectory it is, could change a whole lot, and it's going to come down to who can hang on the longest, and how they're positioned right now will be kind of what things look like in the next couple of years. Is that what you're kind of projecting?
Certainly, and a lot of it will be who had risk management in place at the start of the downturn, right? So I know that's easy. It's always easy to look back, but something to think about. So especially if there's still downside pressure out there, right? What that looks like. So and one thing that I would encourage producers to do is you take a look at where future prices are now and through the rest of the 12 months. Take a look at where your estimated cost of production is, and then sensitivity test it. Not only at one point in time, right? Like I wouldn't recommend just doing the $16.80 average. Pick actual points in time, so that way you can have some idea of what this might look like through the rest of the year of 2026.
Is there anything to glean off of this experience we're in now by looking back over there's been a whole roller coaster of volatility in the last 25 years. Is this trend model like what we saw in, the trying to think what some of the ugliest years were, that 2000, 2003, or when we really hit high corn and low milk in 2009. Is there anything that this looks like? Because the second question would be, is there anything we learned back then that will work now, or is it just the future's so different? It's completely irrelevant.
Yeah, like the years that always stand out to me was 08, 09. Like those were really rough. So there's so there's price cycles, right?
Mhm.
Trying to think of the best way to frame this or answer this without rabbit holing too much. But like, let's just, for the sake of argument, let's just say there's price cycles. There's ups, there's downs, there's, you can kind of sort of map this out, right?
Right.
So those assume, right, an environment of variables that are, not that are still on those same supply and demand curves, right? So like we're moving up and down those supply curves. We're having, changes in demand. We're having some shifts in supply response, right? Um, but like even as we look at cow numbers right now, I think this change in capacity is kind of fundamentally changing that. So like I think some of those old or those previous experiences or those previous time periods, they do offer on that management level some good things. But I do think we're kind of in a fundamentally different shift that's happening. On that management side, like people in 08, 09 will tell you liquidity, right? Liquidity over solvency. So that means working capital. That means, your debt per hundredweight, knowing what that is, knowing what it takes to service debt, and at what price per hundredweight that is. And then also, where can you trim on your input side? Do you forego a year of large fertilizer input prices? Is your agronomics dialed in enough to be able to do that? Do you look at, different cost saving measures on your operation that you could do that in a normal year you may not have to consider, right? But I think conserving cash to the best of your ability, which is way easier said than done, especially when all the bills hit. But being able to do any of those changes that you can practically do, or maybe not spend as much on certain things, even if they are necessary, just to kind of get minimum viable, right? Might be something to think about. So
Minimal viable. That'll be a word that we'll earmark. Minimal viable. Get by for now and move
yeah.
forward.
The
Okay, thank you.
the big thing to think about there though is that like let's look at like if we think about cow numbers, through 2023, 2024, like we were in kind of this low period. And now we've really taken off, right? Well, what does that mean? It means that likely those folks that grew supply chain coordinated, like we said before, they were working with their processor, and when that growth happened, they were there, right? I think we're going to see attrition again and consolidation in the dairy industry through this time period as well. But as we do, there might be some distress assets, some purchasing ability that those operations that are, thinking about that now and kind of planning for might be able to take advantage of. So that's something to think about kind of in the future too. And I often say that, in dairy, we see so much variability, even just from one side of the fence to the other. Whether that's in pay price or in production, in management, in whatever, right? Like there's no two farms that are exactly correct. But one thing that as a general trend that we have been seeing here is that, our milk per cow continues to increase all the time. The second half here of 2025, we saw a pretty big increase in milk per cow. And a lot of that is management and genetics. So as we get increasingly efficient, we're getting more milk per cow. We're getting more milk year over year as well, nationally. But a big takeaway there is that we're also getting a lot of more fat and protein. So, if you're out there and wondering how the rest of your comrades are doing here in the dairy industry, take a look at some of the component numbers. So in November, we were at 348 for protein, and our fat test was approximately 4.6. Sorry, 4.46. So, I've tracked these since 2000 here, and every single year they seem to just keep increasing and increasing and increasing. So, we're getting more and more components into our milk supply all the time. So something for you to think about as well is, where are you benchmarking relative to where some of these national averages are? I think in my lifetime we'll get to a 5.0 fat. I think that that's very realistic. I think, people have said that we'll get to a 4.0 protein. If that's the case, then we're going to continue to see this increase in fat and component production. And one thing to really think about here, I always kind of like to take a look at, if we look at change in milk production versus just change in solids production, as of November for 2025, we had a 2.2% increase in milk production, but we had a 4.7% increase in solids, right? 2% increase in production, 7% increase in solids, more than 7%, right? We've seen this happen where we have fewer cows, fewer total production, and we still have an increase in solids production. So something to think about, right? That means that we're going to need fewer and fewer cows in order to meet the demands of processors. So I think, the cows that are out there are going to be increasingly efficient as we go along. Shelley, is there any questions at the moment? Otherwise, we'll talk a little bit about exports here.
Go ahead. We don't have any questions. I'm going to remind folks that are live streaming with us that you can type in your questions and make sure that you kind of steer this the direction that you want to go. We've got about 10, 15 minutes left here, and any questions from what you've previously seen, type them in, and we'll make sure we spiel them on to Leonard.
So one of the big things right now that's really kind of been holding us up, like I said before, clearing markets, is that dairy export space. And, for 2025, our cheese and our butter fat have really seen really good increases. I'm kind of interested to see where our final 2025 year will come out as far as our total percent exported of solids is. Because as you move cheese and butter, we got a lot of solids that are moving. Historically for 2024, we were at 16% of U.S. milk solids exported. And I think we're going to have, another good percent or two on top of that going forward, just to accommodate for where some of this new processing capacity is. I say that for the takeaway message that I very much encourage producers to know, to talk with their processors and know what their milk is going into, what product it's going into, and then also where that product is going. And as specific as you can get on that, the better, because I think that will really help you understand and manage your risk. Because if it's going into the export market, then that kind of opens you up to a different set of risk and volatility and things to consider versus if it's going into the domestic market. And if it's going to the domestic market, you can divide that out further. Is it going to mozzarella to pizza? Then there's a certain set of things you can track, right? You can look at some of the restaurant performance. There's frequently a lot of these pizza chains put out performance things. Are you going to food service, right? If you're domestically and your product goes wholesale to those food service places, right? Well, that's another set of risk factors that a lot of these economic indicators will be able to tell you where you're what you're likely going to see. And the reason that I bring that up is because I think we're going to see a very big difference in basis and milk checks in 2026. And a lot of it is going to come from this, end product use, where it's going through the value chain, whether that's domestic, international, where it's going domestically, all of these things. So I think if you're really going to manage your risk well and be able to have some idea of where your greater risk exposure is, I think we need to be asking those questions so that we have some idea of how we're going to manage this going forward. Just real quickly, I want to talk about where some of our numbers are coming in, at least in trend. for our production of things, our main products, right? So our cheese production, our total cheese production in 2025 has been up a bit, but our exports have been up as well. So which means that we've been clearing that new product and we've been taking some cheese out of storage. So that's been a really good benefit here for that cheese market. But as I say that, we still have seen a big decrease in the cheese price per pound. So we've went from about $1.75, even just in the last, let's call it the third or fourth quarter of 2025 till now, which is $1.42. So, $1.75 to $1.42, that's a pretty big difference. And the part that I'm really watching right now is that we saw a decrease in price here recently with a decrease in sales. So that to me tells me that I'm very curious to see what the next report is from the National Dairy Product Sales Report, because if that trend is continuing, that means that a lot of people are sitting on the sidelines and waiting to see where that bottom is. Also, the thing to think about here is that as these prices are going down, there's less incentive for the other portion of that supply chain that are utilizing those manufactured products to have contracts. So if there's less contracted because they know they're in a lower cost environment, that means that there could potentially be lower lows and higher highs. So it means that there could be a chance for some risk management there in order to take profits to cover, to readjust to things like this, right? So talk with your risk management professional. That's not my risk management advice. I can just kind of tell you, as these things shake out historically, that's what we've seen. So, I'd really take a look at the NDPSR report that comes out, see where volumes are. It kind of might give us some indicator of where prices might be heading. Like I said before, that high whey protein price has really been holding up that class 3. And I wouldn't expect that to change very rapidly. I think we have some time there, especially as our consumer preferences do seem to be continuing to high protein. We have high protein coffee creamers, we have high protein everything, right? The one thing that I haven't seen yet is a high protein sucker or a high protein cough drop, but feel free to adapt the idea. I'm open to royalties, but I think we're going to see it as a continuing trend in products here as we go on. Few other final thoughts here on where our some of our production of products is. Butter. We saw that in 2025. I think we're gonna go back and look historically as butter being that change in supply has really come online here. And our stocks are more or less even, but a lot of that is going to our exports. And domestic disappearance is strong, don't get me wrong, but it's more or less in range. So we've really been clearing a lot of butter in that export space. Butter prices, we've went from, at the middle of 2025, we were, above 245, 250, something like this. Now we're all the way down to $1.43. So, the good news there, unlike the cheese market, is that when we got down to $1.43, we saw a huge increase in sales. So that's a good sign. It's a good sign that people are, taking action on that bargain price that they are perceiving there. So hopefully maybe we'll see some support in that butter space as we go forward. I know we have just a few minutes here, but I get a lot of questions on this, and I think it's important to talk about. I want to just touch on our world supply of milk from some of our key exporting countries. Right now, we're seeing about a 4.2% increase in milk production year over year in our greatest milk exporting countries. So think Australia, New Zealand, US, and the EU. One of the big things here that's driving that is Europe, but specifically a few countries in Europe. And a lot of it is because they've went through a very kind of prolonged period here of different constraints on production, whether that's input or input prices or policy or disease pressure, all of these different things, right? It seems like one will go away and then they'll get another one, something else that's impacting their operations. Well, they finally had a time period where that didn't happen. And while all of those other things were happening, their margins were still fairly decent. So, we're seeing some reinvestment in efficiency and things like this, and we're seeing a pretty big supply response there. The big takeaway there is, hey, if they have product, that means that we, the U.S. Dairy producer, has to clear our product at a competitive price to theirs. So if we do take a look at where world prices are, they are coming down here a bit, but our price is still significantly less than the world price, but it has to be. We have to stay competitive. Our world price has to be lower if we're going to keep clearing those markets. So, I know that's not great news, but the good news is that we are still moving those products as we do, keep progressing through the year here, hopefully.
So what kind of questions do we have out there from fellow producers? And I'm going to wait just a second. I think now we got such a resource like Leonard that we should pound those questions towards them. I have one question, when we're looking at this graph right now, and you say we have to stay below the cost, that's because of the world. We need to be able to dump our product out there. We've got too much is that correct? Domestic
Correct, yep.
distributors. We're
Yep,
relying.
we have to count for the transportation cost, the logistic cost, the headache cost, all of these things, right? So all of that does take time and effort and money, that's for sure. One thing I do want to skip to here quick, that I think will be kind of interesting for the audience here today, is where we kind of look at some of these trends in how our milk is priced and where some of these price pressures are coming in. So, as we kind of take a look at where our farm profitability, our farm margin comes from, it can be kind of traced back or start to our farm milk supply, which goes into our production system. And as our production system right now is increasing, it is kind of putting some of that price pressure on. What's good though is that our inventories haven't been building. So that's good news. So if we continue to get some of these good sales out there, I think that we'll get some good, we'll be able to get some market clearing and some action happening. But for those of you that are watching, I kind of put a red, yellow, green stoplight analysis around the different factors that are happening out there to price our milk. And there's a lot more red and yellow than there is green. So and as we kind of take a look at where farm profitability is in the future, based off of our guest checks and CME futures and all this, you'd be a pretty low cost per hundredweight operation, with pretty good premiums in order to be able to capture capture that margin, that profitability. One thing I will talk about, and if anybody wants, we can pull up a slide or two and get some numbers and detail on this. But there's a lot of talk about heifer inventory right now. So I'm not here to say that heifers are cheap. That's not my goal, right? And if you're writing a check out for one, you certainly know that. But what I will say is that as we've taken a look at where heifer inventories have been for replacements, and we've looked at cow growth, to me, it's not evident that's going to be the deciding factor on future growth in the dairy industry. So I think that there's enough producers that change their breeding programs to be able to have the replacements that they need when they need them in order to produce the milk that's demanded from any new processing capacity. That seems to be what's been playing out, and I think that's what we're going to see going forward as well. So that's my estimation. And I wouldn't use this low heifer inventory number as a risk management strategy because if you did the last time, it probably hadn't worked out well for you. So hopefully we aren't, as an industry, thinking that, we'll be constrained on cows and we'll be constrained on milk, because I don't really see that as happening.
So Leonard, I'm thinking about competition and competition in the domestic marketplace. The greatest competition against milk or dairy products is what right now? As we're
Uh,
competing for the dollar in the grocery cart, what's our greatest competitor?
Consumer preference. If you look at a cost, if you look at price indexes, right? Dairy is a very affordable source of food and nutrition when folks are going through the grocery store. And ever since COVID, even when we saw when inflation hit and we saw grocery store prices rise, dairy has been a bargain for quite some time, and continues to be. So I think a lot of that just comes down to consumer preference as they're making those decisions down that grocery aisle. The good news is that we've seen people voting with their dollar, and they're buying more cheese. They're buying specifically cottage cheese, right? They're opting for those products that do have that high protein whey in them. So I think that's a good thing. But the big question is, how where is our domestic demand and domestic demand growth versus our change in domestic supply? And it seems like, and what the market is telling us, is that our domestic supply is large enough that we're having some price pressure there. So, hopefully we can continue to clear domestically. That certainly matters. That's where, a lot of that product is moving to, the vast majority, right? But we still need those export markets, and they're going to continue to be, a very big player as we go forward.
Okay. Well, we certainly are good at making milk in this country, making good milk that's full of fat and protein and all the energy. So with that, we're so good at it that we kind of are flooding our market right now compared to what we can create and disappearance, it appears. But with that, there's always opportunity, and we appreciate the knowledge is power here, just for us to kind of look long term. What do you see probably as they talk about the black swan? What is something that could be in a reverse, I guess, of a black swan here that changes everything, that we could get a big kick? Is there anything that you'd even want to guesstimate on? But if I look out 2 years, it feels like the future is so close right now. The future is closer and closer all the time. The industry is changing so fast. What would you look at? And what would you call a black swan? And then where do you think there might be the greatest opportunity that we're potentially overlooking right now?
Milk production overseas is always the lowest hanging fruit in black swans, right? Like what are our international competitors doing? And that plays in two directions. There's been this increasing trend towards deglobalization, where certain countries are investing in their own infrastructure and production as well as processing on the dairy side, as a play for more independence and control of their own food supplies. So if as that does happen, I think that's going to be a very big wild card, because partially because like we went through a process, a revolution. We went from 50 cows to 100 cows, 200,000, right? Like up to, where we're at today, 5,000, 10,000, pick your number, right? We didn't go from 0 to 1,000 or 5,000, right? Well, a lot of the dairy expansions now, if you're doing them on, this greater, let's say, institutional level in some of these countries, where they're, either public-private partnership or they're government supported in some way or fashion, or there's, this increasing collective initiative behind it. They're not going to build 50, 100 cow dairies, right? They're building large sites that can produce a lot of milk, as well as the accompanying infrastructure for it. So we could see this growth go from, not too much, not hitting the radar, to meaningful way faster than historically we did. There's that, right? I would certainly watch that. And also there's a lot of countries that produce more milk than we do. They just don't export it. So we don't talk about them a lot, right? So if there's changes in those countries, that could, kind of change that global landscape too. And then also our current export buyers. So that seems to be shifting and we seem to be clearing product and people are still liking our product. So that's a good thing. But the other things I would watch in the near term, as a producer, the first one is inventories. As soon as we get any sign that we're building inventories, I think that's going to be our first red flag as to, hey, we might see some more immediate downward pressure. And there's always a infinite amount of black swans, right? But I think that those are kind of the first two that I would be watching.
Okay. All right. Well, I appreciate the time that you have spent with us today. This is definitely a topic that touches all of us. Everybody through our rural landscapes are touched by what happens with on-farm margins and the value of land. The whole bit is connected to what we're getting as far as price. So thank you very, very largely for your input today. And I would encourage folks to track with Irv Poseen and the team at UW Extension, the great resources that they're providing, and always keep looking forward because it is only in looking forward that you're going to find opportunity. And one thing about dairy, that is, it is very volatile and there's always the next day can be completely different. So keep looking for it and we'll see you again on Thursday on the Dairy Signal, where we'll be talking about items and topics that are pertinent to your business and helping you grow bigger and better with your future. Signing out from professional dairy producers, make today your very finest.